We are looking live at MingZhu Logistics Holdings, ticker YGMZ, and the price is currently $0.19 per share. That is a staggering 55.02% gain on the day, an explosion upward on the charts that has traders and algorithms scrambling. We've seen it hit a high of $0.24 and a low of $0.16, so it is whipping around wildly. The immediate expectation when you see a move like this, a 55% surge, is that there must be some transformative news, a massive new contract, a buyout offer, a spectacular earnings report. But the reality for MingZhu today is far more complex and, frankly, far more dangerous. The most significant recent news for this company was not a new contract. It was a delisting notice from the NASDAQ exchange, received just a couple of weeks ago on October 20th. That's the tension at the heart of this story. The market is treating YGMZ like a breakout winner, but it's happening against the backdrop of a company fighting to keep its very place on the exchange. The common belief about a stock this far down, one that has fallen from a 52-week high of $15 to a low of $11, is that it's a forgotten, failing enterprise. Investors see a tiny $14.6 million market cap, a negative PE ratio, and the China-based label, and they, understandably, stay away. But what that common belief misses, and what we are seeing live today, is that these exact characteristics, the tiny market cap, the low price, and the history of volatility, make it the perfect target for a purely technical, speculative frenzy. What we are witnessing is not a fundamental re-rating of the business. It's a massive, volume-driven momentum play that is completely detached from the company's underlying health. The proof is in the volume. The average daily volume for YGMZ is around 3.25 million shares. Today, a truly mind-blowing 359 million shares have already changed hands. That is over 100 times the normal trading activity. The entire tiny float of this company is being passed back and forth multiple times over, a clear sign of high-frequency trading algorithms and day traders piling in to ride the wave. So what does MingZhu Logistics actually do? When you strip away the frantic trading, the company, founded in 2002 and based in Shenzhen, China, is a trucking and logistics provider. It operates a fleet of around 132 tractors and 83 trailers, and it also uses subcontractors to manage freight within China. In recent years, likely due to the difficulty of its core business, it has tried to branch out. The company's reports now mention operating through segments like car owner services and even liquor distribution. This kind of diversification in a struggling industrial company can be seen as a red flag, an attempt to find any new revenue stream, however unrelated, to stay afloat. The financials paint a challenging picture. For fiscal year 2024, the company reported about $40 million in revenue, but posted a net loss of $6.2 million. Perhaps most concerning is the cash position, which was last reported at only $698,000. That is an incredibly thin cushion for a company of this size, especially one that is losing millions per year. This brings us to the critical topic of short selling. When a stock with weak financials, a low share price, and a delisting notice suddenly rips upward by 55%, the first word on everyone's lips is short squeeze. The expectation is that a large group of short sellers who were betting on the stock to go to zero are being forced to buy back their shares, driving the price higher. But when we look at the data, the reality is much more nuanced and fascinating. The official short interest as a percentage of the float is actually tiny, last reported at only 0.14%. This isn't a classic squeeze where 30 or 40% of the float is short. The story here is not the quantity of shorts, but the cost to short. The short borrow fee rate, the annual interest rate a short seller must pay to borrow the shares, has skyrocketed. As of yesterday, that fee was sitting at over 52%. That is an incredibly high punitive rate. Let's think about what that means. It tells us that while there may not be a massive number of shares being shorted, the shares that are available to borrow are extremely scarce and in high demand. The float is so small and tightly held that finding shares to short is nearly impossible, and lenders are charging a massive premium. This 55% surge is likely a cost-to-borrow squeeze. Even a small number of short sellers, when faced with a 52% annual fee and a sudden price spike, will be forced to cover their positions immediately. They are hemorrhaging cash not just on the price move, but on the interest payments. This forced buying, combined with the 359 million shares in algorithmic momentum trading, is what creates this explosive, violent updraft. This is a crucial insight for investors. It is not enough to just look at the short interest percentage. You must also look at the borrow fee. You can find this data on specialized platforms like Fintel or Ortex. A sudden spike in this fee, even on low short interest, can be the trigger for exactly this kind of move. This brings me to a question for you. What's your take on this kind of move? Is a 52% borrow fee the real trigger, or is this just pure algo-driven momentum? This volatility is, of course, a double-edged sword. The stock is already pulled back significantly from its intraday high of $0.24, showing that for every buyer coming in, profit takers are running for the exits just as quickly. This is not an investment, it is a high-speed gamble. The risks here are as massive as the day's gains. First and foremost is the Nasdaq delisting notice. The company has stated it intends to appeal the decision and is considering all options, including a reverse stock split. A reverse split, where the company consolidates shares to boost the price, is almost always a sign of distress and often precedes further declines. Second, this is a Chinese company operating under a complex legal structure, which always carries a higher degree of regulatory and political risk. And third, the weak fundamentals and tiny cash balance mean the company is operating on a very short leash. We are definitely seeing the chatter pick up across social media, with traders on X and Reddit pointing to YGMZ as the low-float runner of the day. But these plays are notoriously dangerous. The volume can, and likely will, disappear as fast as it arrived. When that 359 million in volume dries up and returns to its 3 million average, the air will rush out of this balloon, and the price will almost certainly fall back towards its recent lows, trapping anyone who bought near the top. With all this volatility, I have to ask, comment below if you are trading YGMZ today or if you're staying far away from this one. It's a fascinating, if terrifying, case study in market mechanics. Looking forward, the future for MingZhu is highly uncertain. There are two distinct paths. The first is the technical path. The momentum can in theory carry for another day. If short sellers are still trapped and algos keep piling in, we could see another spike. But this is the low probability, high risk scenario. The second and far more likely path is the fundamental one. The speculative volume will evaporate, the price will collapse, and the company will be left to face its real problems: weak financials, consistent losses, and a looming delisting appeal with Nasdaq. The outcome of that hearing is now the only fundamental catalyst that matters. So, to summarize, the market today presented an expectation of great news for MingZhu Logistics, driven by a 55% price surge. But the reality is that this is a technical, speculative frenzy in a $14.6 million microcap, triggered not by a high percentage of shorts, but by a punishing 52% borrow fee. This move is happening in the deep shadow of a Nasdaq delisting notice, and it serves as a stark warning about the difference between a stock's price and a company's actual value.